Welcome to Vivegam V+. In the previous video class, we have discussed about quantitative credit control measures. Today, we are going to deal with qualitative measures. What is qualitative? Here, the central bank is allocate the resource between alternative uses. It includes three instruments: margin requirements, moralization, and selective credit control. Here, first we shall see what is about alternative uses. One is productive purpose, another one is unproductive. If the credit is given to money lenders, we can call it as unproductive purpose because it won't bring any change in the economy. It never create employment and it never increase the income, and there is no development in the economy. Here, so we have planned to allocate the resource between alternative uses, or we can say the central bank uses these instruments to allocate the credit between alternative uses. The first instrument is margin requirements. Have you heard the word margin ever before? Normally business people used to say the word margin because they used to calculate their profit. Margin is nothing but the price of a product minus the cost of production. But in the case of credit control measures, here the margin meaning is something different. The value of the collateral which is offered by the borrower against the loan, and the amount of loan is granted, that we call margin requirements. Here I think you may not have understood, so I will give you an example. Suppose a borrower brings a collateral which worth is 1 lakh. If the borrower gets 80,000 rupees as credit, then the remaining 20,000 we call it as margin requirements, or we can say 20% is the margin here. And in the case of inflation, the margin will be increased. So the borrower will be getting 70,000. If it is a case of the percentage is 30, the borrower will be getting 70,000 as a credit. Hope you have understood what is margin requirements. And next one is moralization. It includes persuasion and pressure. Here persuasion and pressure is given by central bank to the commercial bank to make them follow its policy. Just to make a change in their psychologically they want to bring some change to all the bricks. Otherwise we can say it's an advice given by the central bank to follow its policy. And next one is selective credit control. Here channelize the credit to particular priority sector. Those few sectors create more employment opportunities. So during deflation, the bank may channelize the credit to the priority sector, that is which sector create more employment. When employment is created, automatically it creates income of few people, and it may create growth in the economy. That's we call selective credit control.